For the Defined Contribution Committee meeting. I see Callan's here. Ray or Charles, did y'all have any comments before we get started?
I don't. Thank you, Mr. Chairman. Good to see everyone, and we'll go ahead and get started. Just looking over, making sure that we have everything turned on as far as the streaming and everything. And then with that, we can turn it over to Charles and Callan.
Mr. Chairman, without wasting any more time, I'll let Alex bring us into reviewing performance for the MDC and ORP plans.
Thank you.
Thanks, Charles. Good morning, everyone. Great to see you all. We want to wish you all a very early Merry Christmas and Happy Holidays. So we have a review first of the MDC, and then we'll look at the ORP. If you can open your MDC book, and sorry, it doesn't have a page number, but jump about 5 pages in to the Capital Markets Review section. We will do a brief overview of the big market drivers through the end of the third quarter. And that really, provides the context for the results that we'll see of the investment options within the plan. We'll get a little more detail on that when we turn into the investment committee. But for now, from a high-level perspective, through the end of September.
Alex?
Yeah.
This page?
That's it.
I think it's page 1.
It's page 1
in our books.
Okay, perfect. Thank you. So again, through the end of September, as throughout much of this year, equity markets continued to be very, very strong for investors. Now, we got off to a rocky start, negative month in July. Markets quickly rebounded and ended the period with record highs again. Right, so this has been very, very positive for investors in the MDC. One theme that we've talked to you about before and is still at play is this idea of market index concentration or narrow leadership. The greatest example of that being the Magnificent Seven, the mega cap tech stocks out there. They have really alone been driving a lot of the market return throughout the year and years prior. And that can have big impacts on active managers and their relative performance. So that's why we keep bringing this up. It's actually a difficult period for them to outperform, just in the sense that, it's very difficult for them to overweight these stocks relative to the index because they make up such a huge percentage of the market today. The tech sector did actually take a little bit of a breather in the third quarter. There was some negative performance there across some of the names, and what that enabled was international markets to actually outperform. And that's not something we've seen a lot over the last 10, 15 years. The U.S. market has really been the dominant driver. This is a very nice feature, a nice turnaround for the diversified investors in the MDC, particularly those who may be invested in the target date funds, for example. So that's the equity side. When we look at fixed income, the Federal Reserve, when they met in September, delivered on their first rate cut. It was 50 basis points or half a percentage point in reduction to the short-term interest rates right at the end of the third quarter. And so, that was a very nice tailwind to not only stocks, but particularly bonds. And so fixed income actually had its second best quarter in the third quarter over the last 30 years. Again, a nice turnaround for diversified investors where you have equities doing well and now bonds also contributing a very meaningful positive return. Interestingly, the Fed, we fast forward, met again in November. They cut rates by another 25 basis points, and they're actually meeting today and tomorrow. And the expectation is that when they come out of their meeting tomorrow, they will have announced another 25 basis point rate cut. So that'll be a full percentage reduction in the short-term interest rates starting in September of this year. If you just look to the right side of the page and look at those triangles, you'll see them all pointing up, all in green. Public markets really firing on all cylinders. So both for the quarter and the year, it's been very, very accretive to investors in the MDC, as we'll see in a moment. The intervening pages that we don't have time to cover today, a lot of text, some write-ups that our firm does on the market in various segments. Particularly the next 2 pages, if you have time, I think are very interesting. It's a nice, easy read on the state of the economy that kind of explains a lot of the drivers today. But if you'll jump ahead with me to page 19, we'll take a quick look at the MDC and what's really going on more recently, particularly through the end of the third quarter. So this table kind of arrays how participants have allocated themselves across the investment options and really the change in those allocations throughout the quarter. Now, the two drivers of change, of course, are the investment return, what did the market do, and then the net new investment, money flowing in and out of the plan. If you go down the investment return column, you'll see everything in black. So all of the broad asset classes and all of the sub-strategies were able to deliver positive growth for investors.
Before you leave that, does the record sell-off the last few days that's been more than in decades have any bearing on anything?
In terms of the returns we're talking about?
Stock market.
Yeah, it will, certainly. Post 9/30, there was a lot more volatility in the market in the lead up to the election. October was actually a challenging down month. November was good, but December has been a little rocky. So we're going to have some comments on that in the defined benefit section in terms of market performance. But it will be reflected in the participant experience.
I'd like to know, when you get to that point, what's driving that? Why all of a sudden that happens? But at the proper time.
Yep, yeah, we definitely have some thoughts on that we'll share. So all told, strong investment return across all of these segments really outpaced any cash flowing out. All told, the MDC grew by about $90 million over the 3 months ending September. The only other things that are going to be important in a moment, I want to draw your attention right under domestic equity. You see NT S&P 500 index. That's NT is Northern Trust. That is the large cap offering for participants in the plan. It's the biggest single fund. You can see almost 19%. It has $450 million of participant assets. This is offered at 1 basis point. It's effectively, free, as close as you can get. And we'll continue to eke it down to 0 over time as scale grows. But you're going to see in terms of the total cost in a moment that has a big impact in terms of the attractiveness of the plan from a cost perspective. As fiduciaries, from an oversight perspective, as you look down this page, I think what's very important to take away is that PERS has created an investment lineup that offers participants all of the building blocks that would be used in an institutional portfolio like on the DB side. Now, they allocate as they choose, but you have given them the options there such that they can build diversified portfolios and really kind of best-in-class structure. So that's great from an oversight perspective. Turning to page 20, we'll take a quick look at returns. So, this is going to mirror our comments about the market. I'm going to focus on that 3-year column, right? So if we think about the last 3 years, we've had rising inflation, then falling inflation. We've had rising interest rates and now starting to fall interest rates. We've had a down market and really strong up markets, all in that 3-year period, right? It's been an interesting time, a very volatile time. So you go down that column. What's great about the MDC is that each of the fund options, by and large, over that period, has added value after fees relative to its benchmark. And it's pretty rare to see that everyone over the same time period is adding value. So that's a great takeaway. The roster of managers here are doing very well relative to their benchmarks. That's their primary objective. If you look at the little numbers to the right, that's their ranking, their percentile ranking within a peer group of like strategies. So 1 would be the best, meaning you've done better than everyone else. You'll notice, again, going down the page, that most of the funds are really better than median, kind of top third of the peer group. So from an opportunity cost perspective, the offerings have done very well. Is that a moment in time? Is that a temporal anomaly? Well, encouragingly, if you go to the far right column, the last 10 years, you'll notice a similar theme. So over an even longer period, most of the offerings have beat the benchmark after fees and have done well relative to what else is out there in the market. So That being said, we think the MDC has performed very well for participants. The last piece, if you'll jump ahead to 22, is the cost, as I kind of mentioned briefly. This is where fiduciaries can really exercise the most leverage often, is the cost of the options in the plan. You don't always need to be lowest cost, but using your scale, to exert influence and constantly working down cost is important. If you go to the bottom of the table, you'll notice kind of in the middle, the dollar-weighted cost of this plan, depending on how participants have chosen to allocate their dollars, is 0.26%. Okay? So I can tell you that that is pretty low, just, from our experience. But if you compare that to kind of the median fee offering across these strategies, you'll see that you're 58 basis points lower. So indeed, that proves out that there's dramatically cost efficiency within this plan. And that's really good for participants because they're investing for the long term. And so instead of paying money out in fees or having that reducted from their return to the investment managers, that's compounding over time for their benefit. And to put some dollars to that, you can see about $6.3 million in estimated fund expense for the MDC. If that was at the median level of fees, it would be closer to $20 million. So every year, somewhere from $13 to $14 million in investment fees instead of leaving the plan to the benefit of investment managers is staying in participant accounts for the long run. So again, this is a very stellar report card for the MDC. From a high level, that's what we want to cover for the deferred comp plan. Are there questions before we switch over to the ORP?
I think we're ready for ORP.
Okay, wonderful. The ORP is in its own separate book. And if you'll jump ahead to page 2, a quick check on the 3 vendors that are on offer within ORP. As we know, Corebridge, Voya, and TIA. TIA being kind of the behemoth of the ORP at 50% of assets, over $1 billion of participant assets as it stands at the end of September. Right. Now that hasn't changed. That orientation has really remained consistent through time. If you look to page 10, what does change through time, and I'm sorry, the intervening pages cover some frozen annuity plans. I'm going to take you right to page 10, the open and active mutual fund platform for Corebridge. And we'll just look at how participants have allocated themselves. Again, the PERS has offered all of the building blocks, but we don't control, of course, how participants use those building blocks. And there are some distinguishing features between the 3 providers. When it comes to Corebridge, you'll notice large cap equity has about 1/4 of the assets, and that's offset by about 20% of the assets in target date funds. Target date funds, those who have invested there lately are enjoying a much better experience because stocks and bonds are both contributing positively to returns. And so it's performing much better now. A very diversified approach, something we think that benefits all of the participants, right? And so we're glad to see the utilization there. Now, if we go to Voya on page 21, and we can contrast some of the differences in terms of allocations. Here you'll notice large cap equity in the middle of the page is almost 50% of assets. So a lot more risk embedded in participant allocations here. Part of that reflecting the strong growth of U.S. equity markets, but also as we see in defined contribution plans, participants do sometimes engage in some performance chasing, right? What has done well over the last 10 years tends to draw interest and contributions. And so really reflecting that here in terms of the growth. Less utilization of target date funds at about 10%. Right? So if I was in this plan as the average investor versus Corebridge, you can just start to get a sense of how the participant experience has been from an investment perspective over the last year. But what we really wanted to touch on today is within TIA, because there has been a change there. And so if you go to page 27, as the 3rd and largest of the 3 providers, we're going to focus on target date. So you see Nuveen Life Cycle. It holds about 25% of participant assets. Over the course of the quarter, there was a change in the investment vehicle utilized. So whereas before it was mutual funds that participants were investing through, there was a conversion to what is called a CIT. That's a collective investment trust. It's the same strategy, but a different vehicle. And the reason, one of the motivating reasons for the change was lower cost. So mutual funds have been around forever. They are open to both institutional and retail investors. They are registered by the SEC, and they have some onerous reporting and administrative and regulation requirements. CITs, by contrast, are only open to qualified retirement plan investors. They're not registered with the SEC, but have oversight from the Office of the Comptroller. They're private, they're not listed, they're not exchange traded. Very simplistically, what that means is that they are cheaper to run and they are able to be offered to participants at lower cost. And so we see this as a real win for participants within TIA in that they're getting the same strategy now for a lower expense ratio. And to put that in context, before the expense ratio of the mutual funds was anywhere from 37 to 45 basis points, depending on the vintage. Now it's 33 basis points. So you saw a reduction in cost from anywhere from 4 to 12 basis points, again, depending on the vintage. So that's pretty meaningful. And again, that just benefits participants over the long run, right? They keep more of those earnings and those earnings compound on their behalf. So that is the big change afoot when we're thinking about the ORP. We think this is a big enhancement for participants. And kind of an area that with staff we're always looking at, right? Are there better vehicles? Is there a way to continue to lower cost? And this is a prime example of that. So we'll stop there. That's the ORP from a high level. Things continue to look good, much like we see in the MDC, largely reflecting strong markets. Yeah, we're happy to answer any questions that the committee may have.
Any questions on those two plans? Okay. Thank you all very much, and we'll move on to the Empower contract.
All right, thank you, Mr. Chairman. We would like to recommend that the board approve exercising the renewal with Empower as our record keeper. As you know, they serve in that role for MDC, or Mississippi Deferred Compensation. You may remember a short while back, we discussed with the board informally about some of our larger contracts and which ones we may seek to renew or which ones would be an RFP or so forth. And of course, we did that with several of the ones in the banking arena, but Empower was one of the ones that we informally decided to move forward with a renewal, and now that time has come. So we would recommend approval to exercise this renewal option. The dates, as you see before you, would be January 1st, 2025 through December 31st, 2027. And in concert with this change, with this renewal, two small changes. One would be to reduce the record-keeping fee for the participant, and another one has to do with some administrative changes where we would now receive the float. And with that, just two small changes that are good for the participants in the plan, and we'd like to ask for your approval on exercising the renewal for 3 years.
That record-keeping cost is paid by PERS?
No, sir, that particular record-keeping cost is by the participant. That's the annual
That is
per
their annual
participant
fee
fee.
that they pay, okay.
And this would be going down.
Is there a motion?
So moved. Second.
All those in favor say aye.
Aye.
Any opposed? The motion carries.
Thank you.
All right, watch list.
Next item on the agenda is the watch list. This watch list is just informational only. We will be bringing this back in February with the recommendation of removing Wellington Small Cap. But for now, this information is just informational.
Any questions on that? Any miscellaneous updates?
There are no miscellaneous updates.
Okay. Thank you. Then the Defined Contribution Committee is adjourned. I'll turn it over for the Investment Committee.
I'm going to call the Investment Committee to order. And first thing we have is the market update.
Just real quickly, before we get started, Mr. Chairman, I just want to kind of give a little overview of what has happened with the portfolio since we last met. For the month of November, developed European markets made small gains. Germany actually performed a good bit better than expected, even with the possibility of large tariffs looming. The UK market rose on a rebound in consumer confidence, and with the Bank of England cutting their rates to 4.75%. U.S. stocks regained their leadership with major indices like the S&P 500 up 6%, the Russell 2000, which is a index of small cap U.S. stocks, up 11%, with all 11 sectors of the S&P 500 positive for the first time since March. All this happened post-election. Let's see, the Federal Reserve rate was cut by 25 basis points to 4.75%. The U.S. Consumer Price Index, CPI inflation rate rose to 2.6%, while the core CPI stayed at right around 3.3. Third quarter GDP grew by 2.8%, and the composite purchasing managers index was 5.1%, indicating that the economy was expanding. Asian markets delivered negative returns, with China underperforming. In all emerging markets decline, led mainly by markets in Asia, while European emerging markets were positive. So for the month of November, the PERS portfolio was up approximately 2.5%. So far, for the month of December, U.S. stocks have kind of hovered around their all-time highs that they achieved back in November. U.S. 10-year yields jumped to 4.4%. Basically, there's kind of been going back and forth concerns on whether the Fed should actually cut rates tomorrow by another 0.25% or not. So the market's been a little wishy-washy on that. So anyway, as of close yesterday, fiscal year to date for the fund is estimated to be right at 5.7% positive for the total fund. So with that, I will let you take it from here, John.
Thank you, Charles. I'm going to be covering from the white book here, the Callan book. And I'm going to ask to turn your attention to, if you're dealing with hard copies, probably slide 5 out of your board package, but it's page 4 of the hard copy. So this is the PERS of Mississippi Performance Highlights. This is the one pager that kind of summarizes the key bullet points on the fund. Again, when we met in October, we reported that the fund had returned 5% for the quarter ended 9/30. At that point in time, the peer indexes had not been included, but suffice to say, now that they've been collected, 5, 7, 10, and 15-year performance is all in the top 30% of its peer group, meaning that outperforming 70% of its peers. So we're going to go through and we're going to touch on give you an October update, and we see that the assets stood as of 10/31 at $34.6 billion, and that was a decrease of about $716 million from the end of the third quarter. And again, that's driven by the fact that we had a very robust, as Alex alluded to, a very strong third quarter. We saw a sell-off in the month of October, and then again, the resumption, we saw global equity markets bounced again in November. So this report is going to be showing some negative performance, but suffice to say that when we come back and we're looking at November, you're going to see a better picture in terms of post-election, the market certainly bounced. The negative return decreased the value of the assets by about $660 million, and net flows reduced assets by about 57 million. Overall allocation, which is critically important to trustees in executing their fiduciary responsibilities, underweight to real estate, which didn't hurt you given the fact that real estate versus its target was underweight, and real estate continues to trail the other asset classes. We saw domestic equity was in line, just modestly below, and this was underweight by about 1%. Fiscal year to date, the total fund return was about 3.1% versus a 3.4% return from the policy benchmark. During the month of October alone, the total fund was down 1.9%, and that was matching the total fund benchmark. So again, we're going to go through the different asset classes, but suffice to say, in fact, holding your own during a market downturn is certainly a key. And we look to the detractors for this period, primarily your private investments, real estate, and private equity. Over the trailing 5 and 10-year periods, the total fund returned about 8.5% and 8.1%. So again, well in excess of your actuarial discount rate. So what took place in October? Turning to slide 5, we see that as Charles spoke, we continue to see growth, but we had solid GDP growth and jobs market remaining strong. CPI data declined, but fell a little bit short of expectations. Labor was relatively unchanged. And then the headline CPI rose about 2.6 for the month of October. That said, when we turn the page, we see that, the components that detracted or added, we see that across the board for October, if you look to the bars of this chart, you'll see that all were in negative territory. The good news is when we turn the page, when we look to month of November, we see those returns are going to flip. Turning to the equity markets for October, what led, what trailed? Again, what I would say here is that when we look at the performance, we see that the Russell 3000, which is an index of the 3,000 largest stocks traded in the market, was down about 0.73. But year to date, so this is calendar year to date, still near 20%. Over the last year, U.S. equity markets up 37.9%. So again, we continue to see, when you take a look at the equity markets and you were to go back to 1926 and look at the S&P 500, you're looking at an annualized return of about 10.5%. So these are certainly very strong returns. Another theme that we saw a change in leadership in the third quarter, as we talked about how small caps overtook large cap stocks for the third quarter, which was a little bit of a change. We see a reversion in this particular month where we see that the Russell 2000, which is a small cap index, was down about 1.4% versus the larger cap index, which was down only about 70 basis points or 0.7%. If we turn our flip to November, however, we're going to see that small cap stocks were up almost 11% versus large cap stocks that were up 6%. So what do we have? We've got a lot of volatility going on in the marketplace. We have a broadening, the Magnificent Seven, that is comprised of very large tech stocks, including plus the Tesla. We see that it's been driving the market. In the third quarter, there was a respite. About half of them outperformed, the other half underperformed or trailed in the bottom 10 stocks in the index. And then we see again a resumption when we turn to November. So equity markets still performing strongly, but again, that's in the month of November post-election. And the idea here is the market, what is it responding to? Inflationary concerns are one, because it was pretty much a foregone conclusion that the Fed was going to raise by 25 basis points. And that's arguably still the case, but the anxiety, I guess, is in connection, is looking at the idea of the President-elect's administration, what are the policies that are going to be implemented? Deregulation certainly being stimulative from a economy perspective. The language surrounding tariffs, what does that mean? Is really the devil's going to be in the details in terms of what the policy is, what it looks like. So maybe inflationary, but again, how much of that is going to come to actual implementation is yet to be seen. So the market is trading on the headlines, not necessarily the facts, because they're borne out. Meanwhile, the Fed is a little more factually oriented and continuing to look toward marching forward to stave off, promote the stability of jobs. So that may lead to cutting rates and feeling like inflation is well enough contained. Remains to be seen. So, any questions there?
You mentioned a little bit about tariffs, and I don't really understand how that works, but you hear different reports about how tariffs would affect the consumer to raise into inflation. So how do this, if there's increase into the tariffs that speculated it may come with a new administration, what does that do to pensions? Does it have any bearing on pensions?
Anything that's inflationary potentially has an impact because it hurts your purchasing power. So what you could buy for $5 is now going to cost you $7, for instance. That's an inflationary impact. So that hurts your pocketbook. The idea here is that when you have an increase in prices, it's how much of it can actually be passed along to the consumer. And I think the challenge when you're talking about tariffs is the devil's in the details. What does it look like? Is it a bargaining strategy? Is it to get concessions of a more level trading environment from your friends across the pond? So that remains to be the question. And then is it short term, is it intermediate term, or is it long term? So the idea here is that is it healthy if there's concession from our trading partners to have a greater sense of fair play and no dumping? Therefore, there's a certain leveling that takes place, in which case we would say, well, that's positive long term, but in the interim period, there may be some challenges with respect to, action and then reaction and what that means. So, wish there were a clear path, but it's anything but clear.
It's heavily dependent on the ability of our trading partners to be able to transfer that cost to the purchaser, to the end user. That's heavily up in debate on how much, especially China, will be able to accomplish that. In fact, due to the heavy talk about tariffs, the Chinese government has started implementing heavy stimulus measures in their industrial sectors to help compensate for the possibility of heavy tariffs looming. So there's still quite a bit of data that's up in the air on how much our trading partners are actually going to be able to transfer that tariff onto U.S. consumers. And a lot of the thought is that they're not going to be able to transfer a lot of it. They're going to have to eat a good bit of it. So
the tariff discussion, not only what you all have discussed, but in the financial markets, are they talking about the new administration as they come in to try to drive more onshore production away from China? Because China seems to be the number one that we're going to aim this, our government. Onshore, or drive the production to Vietnam, Indonesia, outside of China that will avoid the tariffs.
We're currently seeing a lot of that.
And the last thing is just planned investment, that will stop going to China. So is that to force them to the table for other things other than what on the surface tariff does? Do you think?
a lot of that's already been in play. A lot of it's called friend shoring, you know, instead of, trading more with partners that are large geopolitical rivals, that we're, trading more with, so quote unquote friends. And then also nearshoring, getting, our, supply chains closer to our shore, so we don't run into the same thing we ran into with COVID with China. So a lot of that's already been in play. And one of them's Taiwan Semiconductor. I don't know if you guys have seen the production facility they're building in Arizona, but it is incredible, phenomenal. So it's already been in works.
I would only add that, in terms of promoting stable, strong employment, and at an affordable price, it's a balancing act, right? Certainly you may be able to get products, manufactured cheaper abroad, but not necessarily held to the same types of standards, that we might have here in the US. So it's a balancing act to make sure, is it equitable? Is it also promoting a level of employment, here in the US? So there's a lot of work in terms of putting together any type of financial plan, and that remains to be seen exactly what that looks like, in my mind. The one thing that we can say is, as stewards of capital for the pension system, the idea here is adequate diversification, staying fully invested, taking the long view as opposed to reacting on an interim basis. Certainly serves the needs of the pensioners, and certainly the fiduciary standards of the trustees. So, with that, shall we turn to the performance? Let's go to page 12 of the white book, if you have that. That's where you're reading from. And you can see that on page 12, this is the asset allocation. You have the asset classes listed to the left, the market value, and then the percentage of the portfolio. So you can see that the largest percentage is in US equities, that's at 26%. Global equities, which is a blend of both US and non-US equities, is at about 12%. International equity at about 20%, and then fixed income at about 21%. Real estate represents about 8%, and that's relative to a 10% target. And then private equity, we have it as about 11%. So private credit was initiated this year, so it's got a more modest weighting, and then cash at 0.5%. So we see that the total fund value is $34.6 billion. And if you just scan to the right, you can see over the last month, the fund was down 1.87% versus the benchmark, which was down 1.9%. And as we look over the fiscal year to date, 310 versus 335 trailing, and that's largely due to the fact that when you look at the, on a fiscal year to date, private equity at about 1.16 versus 1.3. The other allocations are pretty much in line, but we see that domestic equity and global equity both trailing their benchmarks, which is not too surprising given what Charles talked about, and as well as Alex. Really difficult for a lot of managers when a concentrated index is taken off in a handful of stocks, that they may not be holding those stocks at the same percentages. For instance, the Russell 1000 growth, which is a growth index, is about 45% technology. So,
just a clarification
Yeah.
for me. On the red numbers, looking at global equity, it's better to be, for us, our fund, to be smaller than the index. I mean, 1.96 for us, and the benchmark is 2.32, so we're better than the benchmark.
That's right.
On the negative side, it's better to be smaller. On the positive side, it's better to be greater.
exactly.
Okay.
Losing less on the downside and making more on the positive side. So we see that, over global equities, we can see that, over the last 3 years and the last 5 years at 10.5% versus 10.7, trailing the benchmark, and we have kind of a mixed bag on the global equity managers. Charles is going to spend a moment talking about one of those, but we've had some that have been really successful, and again, others that are challenged, and one we are talking about potentially making a search for a replacement.
Now, Charles, is that where you're talking about, we've got 4 managers now,
Yes, sir.
and staff is looking at that, and you're gonna talk about that a little later?
Yes,
did you
sir.
say? Okay,
Yes, sir.
Good.
The other red marks you'll see is fixed income. Again, over the last 3 years, we talk about the challenges with respect to fixed income where you had a rising interest rate environment that again has negatively impacted the value, the appreciation, if you will, of those fixed income securities. So you see over the last 3 years, fixed income has actually been negative, but you can see over the last 12, once rates start to come down, the effect that it has over the last 12 months, fixed income is up over 12%. Those are equity-like returns, but again, very unusual period that we've experienced, as Alex talked about, over the last 3 years. Any questions on that? I would add that when we look at, on page 13, so what you'll see is our large cap allocation is largely driven by the S&P 500 index fund, right, which is the Northern Trust. But Eagle is our active manager with about 881 million. Over the period here, over the last 3 years, you see that it's trailing by about 100 basis points. Longer term, Eagle is one of those managers. It's our only active exposure in the large cap space. And over the long term, they've been really successful. But over this 3-year period, particularly, performance has been challenged. We're not concerned with that. What's done well in this market? Well, the managers that have struggled in this market are growth managers. So just to take a step back, what's the difference between a growth and a value manager? Growth managers are those that will pay more for securities that have an earnings pattern that exceeds the overall market. So think technology, right? That is the biggest allocation to that growth index. And if they're underweight those particular securities, they're going to be particularly challenged. So what we've seen in the mid-cap and the small-cap growth space is a pretty tough time keeping up with the benchmark. Long-term, doing well. I guess what I would highlight is that when you look at DFA, DFA is a value manager. And Charles may speak to this in a moment, but DFA is their characteristics. They tend to be smaller and more value-oriented than their benchmark. So there are periods where they would be challenged, and in fact have been on the watch list from time to time. But if you look at that 36-month number, annualized 8.6% versus 2% for the benchmark. So again, when we think of small cap stocks or even mid cap stocks, kind of the mindset is very much a long-term investment, and that the returns can come in bunches. And when they do, it can be particularly rewarding, as we've seen with DFA in generating an annualized excess return of over 6.5% in the 3-year period. So global equity, as we scan down here, we see that, there are some of the managers have fared really well. Acadian, for instance, over the last 3 years has been up 8% versus the benchmark, which is up 5.5%. We see that Epic for this period of time at about 3.6% trail on the benchmark. Harding Loevner is a growth manager, and again, they've also experienced some underperformance. And I guess what I would say there is that Harding Loevner is a heavier growth manager than you would see with Epic. So we're certainly not delighted with the performance, but we understand it. They've had a consistency of personnel. Epic has had some changes in their leadership of the management of their portfolio. With that, that is the run-through of the overall performance update for October. Happy to talk about any of the numbers if you like, but if not, I think that concludes my report. Sure.
Yep. We do want to cover one last page, if you will. It'll only take a moment. If you can jump to page 42. This is information through September, so 1 month back. We didn't have this ready for you in October. It's peer group information, so it comes a little later on. But if you look at the table at the top on page 42, we just want to remind the trustees, from your seat, from a high level, there are 3 ways to evaluate the success of the investment program. Over the long term, so 5, 7, 10, 15 years, you need to beat your actuarial discount rate. That's very important for the successful funding, right, from the investment side. Okay. You've done that. Additionally, number 2, you want to beat your policy benchmark, right? You want to add value after fees against your benchmark, and you've done that. And then the third lens would be, how did you do against peers? Right, now they have different asset allocations, but it's the opportunity cost, right? Your strategy versus what they did. And from that perspective, over 5, 7, 10, and 15 years, the blue dot, which is PERS, ranks in the top third of large pension systems in the US. So across all 3 of those kind of metrics, assessing the success of the investment program, PERS has done very well. You've done what you need to do from the actuarial discount rate side. You've added value versus the benchmark, and you look quite strong against peers. And so we always kind of like to highlight this throughout the year with the trustees, because this is a really strong report.
I had put in big letters on this page, we're doing better than 70% of everybody else. I think it's sometimes better to say we're doing better than 70% than we're in the 30th percentile. So.
Yeah. Well said. Yep.
Okay.
Yep. And if you go to 15 years, you're doing better than 85%.
Yes.
So.
Mr. Chairman, if I could, I know the answer, but if you would talk a little bit for the committee about the chart in the top right, kind of explain exactly what that means. That's probably another positive aspect there too.
Yeah, we will. The oval is kind of just the peer group of large pension systems, so you can see kind of the distribution of what this is. On the x-axis is your realized risk, so how volatile you've been. And then the vertical axis is the returns able to be achieved over 5 years. And what this is showing you in part is that the blue dot, the total fund, the pension system, has achieved a return in excess of the policy benchmark with less risk, realized risk, actual risk, not hypothetical. And so that's another benefit sometimes of the private markets investments that you have, right? They do dampen the volatility, which is important, right? Because every year you're striking a NAV, it affects funded ratio, you have to pay benefits. And so if you can kind of dampen that volatility without degrading your return, that's a win for the system. And so that's been evidenced in that chart in the top right.
Thank you. Thank you.
Yes, go ahead.
I probably got a C in statistics, so take this for what it's worth. That standard deviation calculation, will you explain that, walk through the mathematics of it, how that's calculated?
So standard deviation is used as a proxy for risk, that basically it takes all the returns in the data set and drives a mean from that. And then you plot all the points relative to that line to give you some sense of standard deviation is how much does it differ from the line, okay? And the idea here is that if you were to look at there are different risk return ratios, but standard deviation is broad. That just tells you, just tell me what the overall volatility is versus the mean of all the observations. So the more you vary up and down from that, the greater level of risk. So you see that you have a return, but how did you get there? Did you go flatline and have a 8% return every quarter throughout the period, in which case you would have a very low standard deviation because you would have your average and then you'd see how many data points up and down, right? So the idea here is that it's beneficial to reduce the standard deviation overall because risk is a drag on performance. So if you've got a flat, straight 8% across the board, you're on a money basis, you're going to make more than if you had a 8% return overall on an average, but you were up and down. Because every time, again, if you're down 25%, it takes you 50% to get back up to where you were to start with. So,
And that line of plotting that standard deviation based on is the median,
actual observations. Yes, that's correct.
based on the average
Yeah.
or the middle?
Average.
Okay. And so however much, so it's not necessarily bad, it just means that it's a lot more outliers in and around that if you see this number go up.
Yeah, because think if you had greater levels of risk in all your observations, but your returns were all above the line, right? So that's a case where that level of risk would actually be beneficial, right?
Yeah, if you look at the chart in the bottom right, you can see that at play, right? A lot of those bars are to the upside. Well, that's volatility, but that's good volatility. You want that. You want to be outperforming, right? And so it works both ways. But that's kind of volatility at play right there. So you look at the magnitude of the outperformance and underperformance and kind of the frequency.
Okay, thank you.
So did I hear you correct to say that standard deviation is really the risk deal? Is that what you said?
It's one measure of risk.
One measure of risk?
Yep.
So if we're looking at that particular chart and it shows that our fund has less risk than the policy benchmark out there does, which goes back to some of our earnings, maybe just a tad shy of the policy benchmark, then that may be because they have more risk in the benchmark out there. Would that be an extrapolation I could make from that?
Yeah, so you could also do well if your return is less than the benchmark, but you did it with less risk.
Yes, that would be better. But I mean, but.
Maybe better, because
Maybe,
it's a ratio, right? And the idea is that when you're looking at that line cutting across, how much return are you getting per unit of risk, right? If you wanted to, if you wanted to take no risk or very little risk, you could put it in a 90-day T-bill and earn 4.5%. And then you'd say, okay, well, what's my standard deviation is very close, but you're earning 4.5%, and you need to earn 7.
Right.
So you have to embrace some level of risk to meet your other objectives.
Well, I was just looking at some of our managers, and some of them, we earn money and we do well, but there always seem to be just a tad off of the index that we're comparing them to. And I was just wondering if that could be explained by their definition of risk that they're investing in versus the other. I mean, in good markets, risk is not bad, but in bad markets, risk is really bad. So I could, in my mind, I could think that sometimes maybe.
Yeah, and there's other measures of risk, right? Tracking error is how different are you from the index? So that's taken into account. What is my measure of deviation from the index? And say, okay, I've got a very high tracking error. And why is that important? strategies that have a tracking error less than 2%, we call those enhanced index strategies. And the idea there, if you've got an enhanced index strategy, certainly it's achievable. You're looking to earn a lower increment. You just don't want to be paying full active fees for that small increment, because now your fees make up a bigger percentage of your excess return. So if you're paying for active management, the idea is you want to get as much excess return as you can for that fee. Yep.
Thank you for taking us to this page.
Yep.
Charles, other things that we need to cover out of the market update?
I don't have anything. We've covered that pretty well.
Then, since that was for anything else from you all, Callan, on that? Okay, then we go to item number 2, be our watch list.
Mr. Chairman, on our watch list, there are going to be a number of changes that I'm going to ask for approval for. I'm going to kind of go in reverse order as they are on the list here. We're going to be asking that Artisan and Riverbridge partners be added to the watch list. Now, let me talk a little bit about the watch list. The watch list is largely procedural. It's just kind of a formal method that, we let our asset managers know that, they may be on the bubble, they're being scrutinized. And it's, just a formal tool that's used. Just because an asset manager falls on a watch list doesn't necessarily mean that they're in imminent danger of, being removed. It's just a formal method that me and my team uses to help us gauge how our managers are doing, and it's in a public manner. So that's what this tool's for. So due to rolling relative 3-year performance, or underperformance that is, for both Artisan Partners and Riverbridge, we're asking that these 2 asset managers be added. Again, there's nothing necessarily wrong with their process, their management teams. It's just that they have broken kind of the cusp on performance, and procedurally, they're required to be added to the watch list. Currently don't have concerns about management teams for these 2 asset managers. It's just procedural. The next item I'm asking for is that Wellington be removed from the watch list. Wellington, about a year or so ago, was added to the watch list due to a large turnover in key personnel in the actual management of this portfolio. There were, at the time, performance issues. We were concerned that those performance issues were coming from the change in personnel. The change in personnel did not hamper performance. Actually, performance has improved greatly, as in seen in the last section, covering performance. So we're asking for Wellington to be removed from this list. And then the final, Epic has been on the watch list since 2022. We're actually currently asking for the ability to initiate a search, and in the next section, we'll be kind of covering a search criteria. Epic's gone through quite a bit of few changes, not to mention, just lagging performance, but there's been ownership changes with the firm. There's been changes in the asset management team, and to be just quite succinct, the investments team has lost our confidence in Epic's ability to kind of fix what's going on with the firm. So we're asking that we actually be allowed to initiate a search to replace them. If there's any questions.
Any questions aboard concerning these 4 changes to our watch list? Okay. The motion is going to be that we initiate a search for Epic we remove Wellington from the watch list, and that we add Artisan Partners in Riverbridge to the
Yes,
to the
sir.
watch list. Could I have a motion for that, please?
So move.
Second.
We have a motion and a second. Any further discussion? All those in favor say aye.
Aye.
The motion carries. We'll carry it to the board tomorrow. The next item, if you want to address that.
Next item is basically covering the search criteria that we're asking for approval that we employ in our process of searching and locating a replacement for Epic Investment Advisors. I can let Callan take you through this unless there's, any questions that you have.
I would ask that you address the specific client request and additional considerations on page 2 of that, I believe. Down at the bottom of the page, just to,
Certainly. So the intention of the candidate profile is that we work with our global management research group to conduct research. So fund sponsor consultants like myself and Alex that have an understanding of the relationship and the accounts and the managers that you have, we provide a profile to our research area showing who your existing managers are and what are the parameters for the search. The idea being here is that enables them to say, hey, we're going to scan our database and look at who they think is the best fit, the best candidates to be placed in your portfolio. One of the things we always maintain an option is that while we think we have one of the most robust databases in the industry, there may be a particular manager that's come to the attention of staff or whoever that either may not be in our database or for some reason might not go through our search committee, and lack of familiarity, lack of track record. If it's the wish of a client to see that particular manager and that information available, we certainly do that. We would conduct a review of that manager, gain that information, supply that to staff and board. So that would be a client request situation. And then we would label that, and if we go through the exercise and, are comfortable that it meets the requirements of our search committee as the best candidates, certainly that would be the case.
primarily, I wanted to point out that not only do we rely on you heavily, but our own internal staff has additional considerations and does have some controls over this whole process.
The reason we ask for this is that even though we highly respect that, Callan speaks to a lot of asset managers, from time to time, we come across an asset manager that just turns out to be a diamond that no one's recognized yet. One that we recently came across was the Northern Trust Small Cap International. It turned out to be an incredibly good decision. Another was the short duration fund, the SID investment, fund. So again, Callan has access to a very good, large, deep database of asset managers, but like everybody, you don't know everybody. So sometimes we just through our meetings with asset managers come across one that just is particularly interesting, and we want to be able to have the ability to review them alongside everybody else. So that's generally why we ask that to be open.
We have a recommendation for staff that we approve the search criteria for a global equity manager. May I have a motion for that?
So moved.
Second.
Have a motion and a second. Any further discussion? All those in favor, say aye.
Aye.
Those opposed? There being none, the search criteria is approved.
Yes, sir.
So we go to the next item then.
And again, I apologize for my voice. I I came down with a cold, so my apologies for the raspy voice. The next two items on the agenda, I'd like to cover them together unless there are any objections. Both of these items are informational. It's the Iran Divestment Act of 2015 and the Israel Support Act of 2019. We've provided a list that's, for both of these, that's provided to us by the Department of Finance and Administration, and also a list of holdings that we have that are on this list. I can tell you over the years, this list has gotten significantly smaller, and the number of our holdings on this list have also become extremely small. We don't have any plans of doing any divestment. We haven't received any, funding to divest. So this is just for your information only. And there's nothing that I'm asking for approval for. So this is just to let you know what our holdings are for each of these two lists.
You want to speak to the first group there, the Iran, and it looks like that our holdings, as I'm reviewing those there, looks like the value right now for those total holdings is a negative number.
Yes, currently, the holdings that we have on the list, when you net out the unrealized gains and losses, we have currently an unrealized loss of almost 400,000 in those assets for the, again, I don't have the thesis as to why our managers are holding them. Those assets are under their purview, but
Do you want to address any on the, are you
And
going to
then-
speak more specifically to Israel now?
any more specific on, no.
On Israel? Any?
Oh, on Israel?
Yes.
Again, the holdings that we have on the Israeli Support Act, the companies that we have, when you net out the unrealized gain losses, we actually have slightly over $1 million unrealized gain in those assets. So if we had to divest from those assets, we would, potentially have, not be sitting on a gain of that, so.
These two items are items of information, and in your estimation, we are meeting current Mississippi state law as to how we're addressing any holdings that we have.
We are reporting what we have, and we are following, the request.
So, any further things on item 4 and 5? Okay, if not, we're going to take a short recess and then come back for the securities, if that's okay.
If I could, it's certainly up to the committee. We're a little bit ahead of schedule. We're planning on having them after lunch, and lunch is ready. If you want to just make it a longer break, and
Don't even know what time it is.
yeah, it's a little after 11, so we're a little early, but the lunches are here. If you
And
want to go ahead.
I've instructed,
Find out.
Mitsubishi to be here a little bit early, so
Oh.
I can, if we want, we can start back early,
Well,
at
why
your
don't we-
discretion.
Why don't we just all play like we're in school and got early lunch, and we're gonna take our 45 minutes or so for lunch right now, along with our break, and then we'll come back and you can kind of advise this group where we stand on time then.
Okay.
Will that be good?
Yes,
Okay,
sir.
so we're gonna recess the meeting right now.
Sound-
Sir.
So we'll be taking up at item number 6, security lending. And as soon as they
Mr.
get-
Chairman,
Go ahead.
about a year ago, we did an RFP for banking services as well as securities lending. We did manage to separate our securities lending program from our custodian. That gives us a lot more leeway if we ever need to make a change. We're not having to make a custody change, to find a different lender, or if we want to make a custodian change and we like our lender, we can keep our lender. We decided on hiring Mitsubishi. We have Tom Ryan and Gus Christakos here to visit with us. It's going to be the first time that you guys have had a chance to meet and visit with them. Really incredible, organization that we picked up with Mitsubishi. So unless there's any questions that you may have that I can answer before they come in, I'll let them come in and share with you what securities lending is and how they do it. Okay. All right, I'll go get them.
Okay, we're ready.
All right.
We're going to go ahead and start. Okay.
Glad you can count.
Good
Hello,
afternoon.
good
Thank y'all for coming.
Thank you for having us.
And just as you get ready to get started, everyone does have your materials.
Excellent.
So we have those, and if you'll introduce yourself, we'll begin.
Sure. So I'll start off. My name's Tom Ryan. I'm Senior Vice President at Mitsubishi. I am head of the Client Management and Optimization Group, which has oversight of the trading desk and the client service team.
My name is Gustav Christakos. I'm First Vice President at Mitsubishi. I'm head of the client relationship team at Mitsubishi, and I roll up into Tom.
Would you turn that microphone just a little bit more
sure,
towards you
absolutely,
right there?
sorry.
That's good.
I can just move
Okay.
over too. Start again?
Okay, you're ready to go?
Okay. All right. Before we get into the deck, and we've been steered towards 15 minutes with questions and answers, we want to thank you on behalf of ourselves and our management team for putting the faith in us to award us this business. We're very excited about the relationship. It's just getting started now, but we look forward to a wonderful long-term partnership.
The first page, or page 2 on the deck, just gives a brief overview of the Mitsubishi Financial Group. It's important to state that we are the 7th largest bank in the world. Securities lending sits in the trust bank at Mitsubishi, otherwise known as a very boring part of the bank, but that's kind of good where we sit. We feel that this is important to state the safety and soundness of Mitsubishi, because when it comes to the indemnification that we offer, that will help explain why our indemnification is considered one of the best in the business.
And I'll just touch on that very briefly, and we're going to get into it more in the deck as we go along. So your organization has exposures to the counterparties, to Goldman Sachs, Morgan Stanley, Barclays, and the like. In the event of a counterpart insolvency and a margin shortfall, if there's a deficiency, Mitsubishi steps in. So we backstop the counterparties, offering this extra layer of protection that we think is the strongest and most comprehensive in the business. Okay. We're regulated by the OCC. We're very heavily regulated by the OCC. They're very hands-on regulator. We also have a very robust internal audit, external audit. We have an apparatus called the Fiduciary Audit Committee. It has an independent chairman. That is a near yearly kind of internal audit on our fiduciary activities. We also have what's called the risk control self-assessment construct, which is a 365-day-a-year project initiative to look at all of our controls. The way that I describe that is it's almost similar to how the Golden Gate Bridge is constantly being painted. Once it's done, you start over and keep going. That's how we do with this risk control self-assessment. Mitsubishi's culture is very conservative. It's very into the audits and protections. So hopefully that gives you comfort as well. Okay, so why do people engage in securities lending? Okay, securities lending offers an incremental revenue stream. Okay, very conservative in nature. We lend securities in its simplest form to a Goldman Sachs and Morgan Stanley. We take back cash collateral. We invest that cash collateral in very safe, short-term liquid instruments that you have all approved. That generates a yield, which generates a gross spread, and we have a slide for that later on. And that gross revenue then is split between ourselves and the Mississippi Employee Pension Retirement System. Our counterparties, as I touched on, are the Goldman Sachs, the Barclays, the Bank of Americas that you've all approved, okay? We could entertain a counterparty. We on our side might want one, but unless you approve them, we cannot transact with them. You conversely could present a counterparty to us that we're not comfortable with, and we would not engage with them because ultimately it is our risk since we're backstopping, okay? Very robust process with that. What other entities engage in securities lending? Public pension plans, state treasurer's offices, sovereign wealth funds, basically anybody who's long securities. And the preponderance of people who are long these securities do participate in this activity in some form. What asset classes typically, or the ones that generate the most income are U.S. equities, U.S. governments, international equities, corporate bonds. General rule of thumb is if it trades in a OTC fashion, it's something that we would entertain lending. What do we not lend? Commodities, real estate, private equity. Again, instruments that are typically not seen as, say, over-the-counter instruments. So basically, your major asset classes. And here we go. This, what we have here is the 2023 industry revenues, okay? And this is exactly how we would expect it to see. Equities dominate this sheet here, especially if we put the ETPs and ADRs into that category. But we also have government bonds there. So why do people borrow government bonds? Government bonds are considered high-quality liquid assets, the safest assets that there are. A lot of our counterparties borrow in treasuries and then will repo out or place out lesser quality assets for balance sheet management, okay? They basically take in the treasuries and they put out, say, high-yield corporates. Balance sheet looks a little bit better. Why do people borrow equities? I won't, sugarcoat this. A lot of the activity is to facilitate a leg of the short selling process, okay? So a hedge fund, say at Goldman Sachs again, thinks that Tesla is too high. One way that they can place their hypothesis is to sell it high, hope to buy it low. But in order to sell it high, since they don't own it, they have to go to someone who owns it, which would be someone like yourself. So I think we cover that in one of the next slides. But again, in its shortest explanation, they'll need to come ultimately to an agent lender to go to a beneficial owner to lend them the securities to go through that chain. Okay? We cover that a little bit more in one of the other slides.
We're going to go to page 5, role of borrower or lender. One of the things my desk does is monitor the collateralization of your loans. We want to make sure that it's at least 100%. Most of the time for equities, it's at 102, and for international securities, it's 105. It's very important that we keep those collateralization levels. It's a safety feature. Even though we're not involved, my desk, in the actual collateralization, we monitor them every day to make sure that our clients, Mississippi included, are fully collateralized.
And since it's, again, our risk, it's incumbent upon us to have the highest haircut levels, margin requirements, that we think is applicable to a given counterparty. The higher you raise your margin requirements, less likely they might be to borrow, so we have to find that right mix. But again, it's really on us to make sure that we have the right margin requirements. Obviously, you feel safer the higher there are. But again, we're watching that in part for our own best self-interest, since we're taking on the risk.
Another facet of securities lending that my team takes a high look at is your recalls. Now, that happens when you sell a security, or your investment manager sells a security, it is out on loan. We need to get that back within a settlement cycle, which now is T+1, so it's even more important to monitor those. So we monitor your shorts, which is what happens when the sale happens against the loan, and we make sure that it's back in good time. And because one thing we do not want to do is impact your settlement. We want to work behind the scenes so that everything you do happens no matter what, and the securities lending incremental revenue is going on behind the scenes.
And we have 3 teams that monitor this. Typically, it's just one. It's typically just done in the operations unit. We're hypersensitive to this, so we have our operations team, which is their bread and butter to monitor this. Gus's team is watching out for basically the client's sake, and the trading desk is looking at the recalls too, because they're going to have the best view into the liquidity or illiquidity of a security that's on loan. So if the sale is for 10,000 shares, they might say, well, let's recall 20,000, or let me call the borrower and say, this one looks a little bit hard to borrow, I need it back. We expect the teams to look at your trading patterns, or your investment manager's trading patterns. If 10,000 sold today, 10,000 tomorrow, 10,000 the next day, well, we should see which way the wind's blowing and maybe recall that whole security. That has a revenue diminishing effect, but it's very, very small, and it's, we think, the right approach.
And one of the things that separates us as well is all those groups that Tom mentioned just now, client service, the trading desk, and operations, we're all in the same room. I sit right next to the trading desk. And in fact, one of the items that Tom just mentioned about seeing a sale happen over and over the course of the day, or days, that just happened. And I went to the trading desk over here. I'm like, just call Goldman Sachs, tell them you want the whole 50,000 back, because eventually that's what's going to happen. And we have our operations team right behind the trading desk, and it's a constant stream of communication during the day.
And much to the operations group chagrin, both Gus and I came out of the operations group. We both ran the group at one point, so we stay very much on top of that group.
Yes, it's not a lot they can say to.
And they can't say, well, that's not how it's done.
Let me ask a question. In an effort not to have to, disrupt a loan that's out, if there are shares of the same company that are being sold in a particular portfolio, can you look across our portfolio to, let's say,
Absolutely.
another asset manager?
Absolutely.
And
That's our first
So
option.
not only
Okay.
just will we look across your portfolio, but we would look across all the portfolios we have in our program.
Right, okay,
So a security would have to be very heavily lent, right, which in turn should be generating commensurate revenue,
right,
right, for there to be an issue. Yeah,
okay.
yeah.
When we lend your securities, not only do we want to work in the background, the entity that we're lending for retains full ownership and economic value of those securities. The only part that's not the same is on proxy voting, and Tom will go over how we, as a lender, will help with the proxy voting for yourselves.
Yeah, you can structure your proxy stance any way that you'd like. It can be don't do anything. It can be every single security that announces a proxy take it back off of loan, even if that proxy is 6 months into the future. If that's the stance, that's the stance. We could work out a construct where we work with staff or investment managers or whomever it is that you designate to say, well, this security is generating X amount on loan right now. So would you like to forego that revenue in order to participate in the proxy? Or they might say, I actually don't, I'm not that concerned about that proxy for whatever reason, so leave it out on loan. And that's what we can work out with your staff, Charles, to put that right.
Generally, what we do is we leave that up to the asset manager. If the asset manager feels strong about the necessity to vote those proxies, then they'll reach out, to have them pulled so they can
Yeah.
vote. But most of the time, they leave them on loan.
Right. And we don't need yourself or the investment managers to notify of these proxies. We have vendor feeds that come in and we see it the minute that it
Right,
comes
okay.
through. So, yeah, again, that helps with any particular stance. And if it was a stance just on one investment manager as opposed to all, that's fine too.
Right.
And that actually goes into everything that we do, which is as you customize the program, and this is what we think is one of our calling cards, it doesn't need to be one size fits all.
Right.
An investment manager can be different than another one. An asset class can be treated different than another. However you want it, we can structure it.
Thank you.
Okay. So, yeah, I touched on it before, but it's not entirely intuitive as to exactly how the revenue is generated. So I'm just going to explain that just once again real quick. We lend the security to a counterparty. I keep using, say, Goldman Sachs as an example. And the security goes to them versus the cash collateral. So it would be, say, Tesla at $100, Tesla share goes to them, the cash crosses to us at $102. If Tesla goes up the next day, we ask for additional margin. If it goes down, we send back the margin. So we're always keeping that margin. Okay. We take that cash and we invest it into an investment that's been authorized by the staff and approved by yourselves, and it's in the contract. And that investment will generate a yield. So hypothetically speaking, if it generates a 480, okay, we're going to get 480 basis points that's going to come into us. But if it's a very liquid security, if it's, say, Microsoft, that everybody owns Microsoft, the borrower is going to say, well, for me to borrow Microsoft, I need you to rebate back or pay to me 450 basis points, in which case we would make 30 basis points gross spread that we would split with yourselves, okay? The more liquid a security is, the less of that rebate rate we're going to return to them. We might say, I'll pay you 1%, which now the spread is 380. It could even be so special that we say, not only are we going to not give you back any of the cash, you're also, not giving you any cash, sorry, any of the yield. You're also going to pay us a fee, 500 basis points. So we would make the 480 basis points on the investment. We would collect 500 basis points from the counterparty for borrowing that security. That 980 basis points is times the notional dollar amount divided by 360. That's our gross revenue. So what we hope for is we hope for widespread securities, what we call specials, what we call hard to borrows, okay? Because now we're making good spread on smaller amounts as opposed to large amounts, which is fine too, just at the smaller spreads.
Why do they need a security rather than the cash?
So now, in the scenario you're asking, would it be equities or would it be a U.S. government bond? You want to stick with equities?
Yes.
Yeah, yeah. So what they're doing with that equity, Goldman Sachs, is potentially, but this is a predominant thing, their hedge fund will have sold Tesla. So they need to deliver that to that purchasing counterpart.
Okay.
That loan stays open, they've got an obligation to return it. And whether Tesla goes up, goes down, whatever it might be, when we say return it to us, they have to return it to us one way or the other. They could borrow it again from someone else, or they could go into the market, purchase it, and then return it back to us. Yeah. Okay. I mentioned before supply and demand. Supply and demand is tantamount in our business, right? The supply of the clients like yourselves versus the illiquidity. Well, the illiquidity is part of the supply, whether it's large or small. And then the demand. How much is the borrowing broker willing to pay to borrow that security? The more we widen the spread, the more they might say, I don't want to do this anymore. How the security is acting in the cash market might change their minds too. So if they're convicted at Tesla to go down at $100 and it goes up to say 120, well, on paper, they've got a $20 loss. They might say, I don't want to experience any more losses. I'm going to unwind that trade. Maybe I'll try to find someone else to go after, okay? One thing we've seen is counterparties maybe not staying in some of their trades as long as they had traditionally, maybe not having as much conviction for some of those items. But again, supply and demand means everything. And then, yeah, last thing on this page, we just mentioned, ultimately the revenue was split between ourselves and Mississippi. So our interests are perfectly aligned with yours.
When
No
do you,
other
when do you
fees.
generally see securities lending do better? In up markets or down markets?
Volatile markets.
Yeah.
Volatile markets.
Right on.
Yeah, yeah. You know, I'm not an investor. I'm not an arbitrager, right?
Right.
I, for a long time, made a false hypothesis that as the market was going up and up and up and up, we were going to see wider and wider spreads. I
Right.
was wrong
Okay.
for a long time. When we see the volatility come in is when we see better activity.
Right.
When we see things like tender offers, merger activity, that spurs things. When we see IPO issuances, okay, especially IPO issuances, there's a lot of them, and maybe not with large offerings. Those will be things, okay? But in a kind of steady as they goes upward market, ironically enough, it's not always the best environment for securities lending. Yeah.
Okay.
Sounds like it's people trying to time the market here to some extent.
Yeah, on the other side, for sure, for sure. Now, the I guess beauty of it is, you know, as it pertains to this product, you know, it doesn't matter how they do on their side of the trade, right? Now, what we root for yourselves' benefit, is for you to make good money on the securities lending revenue while the security itself performs. So like a great example, I keep throwing Tesla out there. Netflix is another really good example where for years and years, people were borrowing Netflix, thinking that it wasn't going to become what it is. And the long holders got to make all of their long returns as well as the extra revenue from securities lending. So, you know, great story. Amazon would be obviously another one that way back when people were tripping over themselves to borrow Amazon. And obviously, you know, unless someone did something in a very short window, it turned out to be the wrong side of things.
There are also situations where, you know, where they're not winners, but the securities lending revenue that's generated on the stock keeps the stock afloat. We've seen situations where
Yeah.
the price of the stock was going down, but your securities lending revenue that was generated on it kept the basis point of the trade even.
There was a security, it's escaping me right now, I think it's called Tilray. It was a cannabis security, right, was it? Okay. And the demand for borrowing that security was such that if the borrower demand and what we were charging remained the same through the year, a client could have had that security stay flat throughout the whole year, and they would have doubled their actual total return by the securities lending income. So, yeah. Good spreads depending upon the situation, and, you know, over the long term, we think it's definitely a value add product for long holders.
And in that case, it was because of the demand for
Yeah.
that particular security?
Yeah, the demand was insatiable. This was, you know, when these cannabis securities started coming around, I think some of the folks that were looking to be on the other side of it would say, you know, I'll go, say, short any one of these cannabis, but I really want to go short this one or that one. Maybe it was exhibiting outsized returns. And that happens. We over the years, we've seen this with solar companies. We've seen it with renewable energies. We've seen it with, not to bring up bad memories, subprime mortgage companies, right? These thematic, industries. And, we're always keeping an eye out for what's next. Space exploration, I don't know, But whatever it is, we're going to try to monetize it as best we can for yourselves.
How difficult does it become for the borrower to return the identical security?
Yeah, so in that scenario that I described, it would be difficult, right? Because the borrower cost is so high, right? It's so high for the reason, like the supply-demand equations got so bad. But in the event that they didn't return the security, we always have the option of taking your cash collateral and saying, you don't even need to you don't need to return it anymore. I just bought the security to return into my client's account. And even if there's a shortfall between, the sale and say where the borrow price is, you'll be made whole. Yeah.
How would you compare our collateral requirements to other similarly situated pension funds or programs that you've worked with?
I'd say they are, if we say this is the most conservative and this is the least conservative, I'd put it maybe north of 50%,
Gotcha.
under 75.
So
Okay.
leaning toward the least conservative, or I forget which way? More
Yeah,
conservative.
correct.
Okay. all right.
Least,
Least.
yeah,
All
right. But still very safe. So for instance, right now, your investments are in reverse repos. Okay? And this is something that we have not touched upon yet, is in our program, in those reverse repos, if there's a counterparty default, we indemnify against that too. Now, most of our competitors, most people in our space, they won't do that. They'll indemnify on the loan side, not on the reinvestment side. Okay? So a different way of saying that is, to what extent are we offering a higher degree of, say, risk versus our competitors? Okay? Okay, so just a couple quick anecdotal things here. Because in some slides before, I had said that the U.S. equities and the government are predominant in earnings, or certainly for yourselves right now. We just put this slide out there just to show you what the industry's revenue generation was coming from to 2023. If yourselves or your investment managers are in any way at all interested in, say, the securities, specific securities that are driving your revenues, we're more than happy to provide that. We can provide it on a daily basis. We provide it on monthly, weekly. We can write commentaries as to why it is we think that people are borrowing. We've got all the data in the world that we can show to you, and obviously we're providing a reporting package right now, but we can enhance that in any way that people want to see. Broad statement, but I stand by that. Government bonds here, this is, again, an important asset class. You'll see an upward trajectory towards 2023 as the counterparties are doing this, again, balance sheet collateral management. It's dipped down a little bit, but it's still very strong. Okay, and then thought I would just land here on the risk page. We've covered a lot of that through the presentation, but I think this is very important. Again, just so you can visualize the risks and visualize where our indemnification steps in. Again, we lend to Goldman Sachs at $100, and we take back 102% collateral. Goldman Sachs goes under, we have the 102%, okay? In the event, so there we're good. We don't need to step in. In the event that the market changed such that overnight, it's 99%, right? You get $100 of securities on loan, there's only $99 worth of collateral. That's our problem, right? We're gonna take the $99, add $1, buy the securities, and return it into your account. It's not, well, it was $100 on this day, and then the market changed and it's now 98 and you only get, 98. No, and we're not replacing the dollar amount. We're replacing the security. So if it's 1 share of Amazon, well, not 1 share, let's call it 1,000 shares of Amazon. We owe you 1,000 shares of Amazon. Amazon could have gone up times 4 the night before. We owe you 1,000 shares of Amazon, no questions asked. Same thing goes for the reinvestment side. We send to a counterparty $100 million of cash. They send back to us $105 million of securities. If those securities drop down to $98, we owe you $100 million worth of cash, period, end of story. Not, hey, there was 98 in the box, we sold that, and here's your 98, it's 100. Okay? So counterparty has to go out. Needs to be less margin shortfall. And then God forbid something happens to Mitsubishi too. That's before you even slightly entertain any even crystallization of $1 and that of a loss, and that's not even getting into bankruptcy scenarios. Okay. The last thing I have here is reinvestment risk. This would be if as your agent, we were buying what we call outright securities. If we were buying commercial paper, if we were buying short-term floaters that you approved, if that went down, that would not be our risk. That would be your risk. So if you say, yes, you can buy A1, P1, CP, and God forbid something happens to an A1, CP, A1, P1 issuer, then that would be your issue. Okay, so I want to be very clear about that. Okay, the next page here gets into some of the, say, granularities of the dual indemnification, the both sides, and some real technical questions about the timing of it. I described some of these timing issues. There's a industry issue out there regarding an is-to-stay protocol in the event that a GSIB unfortunately experiences a distress scenario like Lehman Brothers. There's a timing effect. Potentially, they might call a stay in which the whole world has to kind of sit on their hands. If we come out of the stay and there's any margin shortfalls, our problem, not yours, with our indemnification. If you require us to set up any sort of call or provide any additional information regarding the granularities of this, we're more than happy to do it. It does get a little technical, so please let us know if you want to dig into that a little bit more. Okay. Okay, the last page that we have, at least for the presentation, is your approved counterparty list. We touched on this before. This is the kitchen sink of approved counterparties. We typically lend to the bulge bracket firms, okay? The firms that you would expect to be represented in the league tables, who's the top broker dealers in the equity space, who's the top in the fixed income space. That's who the preponderance of your balances should be with. And again, we review this. Do you review this how often with the client?
Well, once a year we'll go over.
Once a year we go over this. In the event that for any reason at all, we think that there's an issue with the counterparty, we would not hesitate to, on our own, stop activity with that activity. We would certainly let you know that. But take, for instance, like the Credit Suisse scenario. We decided early on that it just was not worth even optical issues to have exposures to Credit Suisse. So we stopped lending to them long before other people in the industry did. It's just it's part of the Japanese culture and part of what we like to do in terms of being forward-looking from a risk management point of view.
If there were a new one that you wanted to bring on, you would bring that to us first?
Absolutely.
Give us first right of, veto if.
Absolutely.
Yeah, we would never turn on a new counterparty that's not on this list.
Oh, it would, and Charles, it would be so signaled to you because it is it's not terribly time constraining, but it's a very onerous process for us as a firm to get credit for some of our counterparties. It's just such a robust apparatus that needs to go in to monitor a counterparty. So we have to sell it to our head office before we could even say, bring it to you as an option.
Right.
So we would tell you, we'd say, we've started conversations with head office to secure a credit line to deal with whomever the next one might be.
Right, okay, thank you.
Okay?
How often do you encounter issues with the counterparties? I understand you're obligated to cover it, but just generally, how often do you encounter problems?
Very, very infrequently, and it would be obviously the names that were public, right? With Lehman Brothers being
Yeah.
the granddaddy of them. A couple of smaller ones here or there. But yeah, I'd say Credit Suisse was the last one that caused some angst. Right? Didn't cause any issues to anybody that still transacted with them. And then before that, there was some smaller entities. Yamichi, I think, was one. A couple of, that's when there was a lot more counterparties out there too. So yeah, thankfully, not that often, and we'll see. Yeah.
To piggyback off that question, are there early warning signs with your counterparties that you can stop working with them before, they fail to meet their obligations with you,
Yeah.
even though it is a rare occurrence?
Yeah, it's interesting you say that. One of my personal red flags is a counterparty that we haven't really been doing a lot of business with, and now all of a sudden they want to do a whole lot of business, just out of nowhere. Now, since we're already dealing with the bulge bracket firms, that shouldn't really happen, right? We shouldn't have a bulge bracket firm that we're not dealing with, and all of a sudden they want to do business with us, right? That would mean like they have like a personal issue with us, which they don't. But if it's a smaller entity, and all of a sudden now they want us to do a $500 million reverse repo out of nowhere, we haven't heard from them forever. Yeah, I'm going to have a red flag on that, because the first thing that's come to my head is, did somebody pull $500 million of financing from them? So we would take a little bit of a pause for something like that. When we have our new counterparty relations, we sit down with them and say, well, what business mix are you in? What should we expect to see? Well, we could use some financing here. We're big into corporate bonds. We're big into this. Okay, fine. So when any trading activity falls out when it looks like an anomaly, that's a red flag that we're doing. And that's on top of all the credit and risk work that's happening on the other lines of defenses, right? That we don't even see. The people that are, analyzing each company's balance sheet and financials and things like that. Yeah. Anomalies is what we're on the lookout for. And we have all sorts of dashboards. Gus has got client dashboards. I've got trading dashboards. We're looking for those spikes.
Yeah, you will see a trend on how the counterparties, what they're borrowing, right? Okay, so maybe BOA is heavy in the corporate bond world, and Morgan Stanley does more of the ADR equities. So what Tom says is all of a sudden, something switched,
Yeah. Unsignaled. Yeah.
Other questions from the board? Yes.
Representative revenue share with the client?
Oh, the split?
Split.
88-12. You're the 88.
In those events where you may have a stay, right, regulatory puts in a stay, what is the duration and what happens during that period?
Hasn't happened. So it hasn't happened. So this is the state protocol. And again, we're happy to set up a call specific to that. This was 2019, 17,
Yeah.
something like that is when, and I would not imagine, you're certainly a signatory to that, right? But thankfully, there hasn't been a large counterparty in any jurisdiction, because it's all jurisdictions, right? The British regulator could call a stay, and the expectation then is that the American regulators are going to follow suit, okay? Yeah, that is something that we certainly hope never happens, but we're certainly prepared for it to happen, okay?
Untried on any scale.
Correct.
Okay, thank you.
Correct, yeah.
It's if they thought they would be able to save the entity by, instead of.
That was the whole purpose, was the regulators, I guess, writ large, thought, well, maybe if we had enough time, we could have saved Lehman Brothers. We could have reorganized it. But then the flip side is, well, while we, the regulators, are trying to rescue them, the folks that have financing and loans out, that everyone's rushing for the exit, so it's going to be a self-fulfilling prophecy. So if we, not to speak for the regulator, but I guess what they're saying is, if we could tell everybody that they have to sit on their hands while we at least attempt to straighten this out, then maybe we can lift the stay and they'll remain.
Thank you.
Other questions? Charles?
I have nothing else.
We thank you all for coming, sharing with us. It's great to meet with the people that's handling our security as lending. And tomorrow, during the, we will receive a report on how that's been doing over the last year or so.
Okay.
They just started full-time lending for us in October.
October?
Yeah.
We will see, we'll look at the whole month. I know that we have a whole page of security.
Yes.
In there, so y'all just started, so we'll check out.
It's very short right now.
Good.
What I did is,
So much.
I did add them to what our previous lender was doing, but I put a footnote that,
Okay.
for October, this is Mitsubishi's, performance.
We look forward to coming back when you'll be able to see a full year data.
That will be good.
Yeah.
We'll be looking forward to it then. Thank y'all so much for coming
Thank
down
you.
and
Thank you.
sharing with
Thank
us.
you very
Our
much.
pleasure. Thank you very
Have a
much.
good day.
Be careful with the microphones, because
Interesting. That's it.
Charles, that's the best explanation of securities lending that I've seen.
Yeah, they're a good group of guys, and
On the board.
they speak at a level that everybody can understand. I enjoy talking with them, so.
We're at item number 7 now, I believe. Miscellaneous updates?
The last item that I have to talk about is, there's a few of them in here. The change in asset management with Harding Loevner, we basically covered it last time when they were in speaking with us. The one thing that I would like to focus on is the item here from Bally Gifford. It's good to see that asset managers are finally starting to get back to focusing on core business. And so it took Bally Gifford a little bit of while, but they finally came around. They decided to withdraw from the climate action and net zero initiatives. Again, net zero, if that's possible, I'm all for it. I don't have anything against that. But what I want our asset managers to do is focus on building our assets. Not trying to save the world, but building our assets. And that's good to see from Bally Gifford. And with that, that is all I have for this meeting, sir.
There are others, as others withdraw from these organizations and that sort of thing, if you hear of them,
I will bring them to
would
your
like be
attention.
Made aware of those, because some of these are voluntary and some of them are country-oriented. The country tells them that they have to participate in some of these, but Bailey Gifford here apparently voluntarily went into this, and they're voluntarily leaving. So I think that's a good thing, Charles. I appreciate you bringing this to our attention.
Okay, thank you.
Anything else for the investment committee? If not, the investment committee is adjourned. Mr. Chairman.
Thank you.
And we start at 10 o'clock in the
10
morning?
o'clock tomorrow.
Except for you.
Yeah, I'm
glad.
Except Butch, I want to see Bailey Gifford.
That's
You know,
right.
he wasn't such a